Welcome to the Transparent FX Academy. I'm Nick, and I'm a top author on TradingView with over 190k reputation points. In today's video, I will be speaking about supply and demand areas in forex trading and how we can create a strategy around them. The way in which I will be dividing this video is first speaking about the technical side of supply and demand areas. Then we will be speaking about adding order flow to actually test if those supply and demand areas are actually strong. So how can we use the orders of institutions and the big players, so the smart money in the market, to actually test if those supply and demand areas are actually strong, which is the COT data. And then we will be speaking about how we can integrate these two concepts to actually develop a strategy. So I really suggest that you stick to the video until the end because there is a lot of value to be taken from here. So without further ado, let's get straight to the charts. Okay, so starting from the first section, the technical side of demand and support areas. So how to spot them and how we can actually use them. Now, when it comes to this concept of supply and demand, it actually determines where you have the probabilities of having a rejection in the market. And the way in which you determine these areas where you have high probabilities of a rejection or at least a reaction to the market, to these areas, is by looking at past price action as usual, which is the basic point of technical analysis. We look at the past to try to understand which are the areas that the market likes to react to. So in the case of supply and demand areas, what we're actually looking for is areas of price at which the market has created a turning point at, so a rejection at. For example, taking this one here, what we can see is that the market here was trending to the downside. Exactly at this area, at this price, the market shifted its direction. It was going to the downside, it started trending higher. What this shows is that at this area, we were having very strong demand. Now, how you identify a demand area is how I suggest that you identify a demand area is by using a box. And the way in which you actually place this box is by zooming in and putting the lowest end of the box at the bottom of the wick of the candle that created the low. And then when it comes to creating the higher end of the box, you will put it at the start of the bodies of the candle. So basically you're taking only the wick. So you're taking the box from the bodies all the way down to the wicks. Now this box, if you extend it to the right, will actually give you your demand area. So what you expect at this point is that if the market will once again go and test this area, you at least expect the market to try to reject it to the upside, because when the market reaches this zone, you do expect the market to find demand at this area, from which we then expect a rejection to the upside. If we go forward, we can see that when the market went and tested its zone, it tested exactly the box that we have identified. In fact, the market went in the middle of the box, which is why I suggest drawing it in this way, because this is the most accurate way of drawing it. And from here, it rejected it to the upside. Once again, the market here tested its zone and it started rejecting it to the upside as well. Now, this doesn't mean that if you have a demand area, the market cannot break it to the downside, but at least the market is supposed to react to it, show some kind of reaction to the area. Now, a very important concept is that if you have a demand area and it gets broken to the downside, that previous demand becomes supply and resistance. So in a situation like this, if you were to look at the market from this perspective, okay, you have nothing on the chart. You have a market here and you want to identify the nearest supplied zone. In this case, the nearest supplied zone would be exactly the same area that we have previously identified, because it would be this one here, which is previous demand, which is now turned supply. So if the market will now go and test this area, what you would expect from here is a rejection to the downside. So for the market to actually react and show a reaction to the area. And what we can see is that, in fact, when the market goes and tests this area, once again it rejects it to the downside, confirming that we did in fact have strong supply in this zone. Now let me give you a couple of other examples of this concept. For example, we can go here. If we are in a situation like this, okay, where the market is breaking below all the structure, you have a situation like this, you're looking at the market, you say, okay, where is the nearest supply area? You have to look left. Where is the last time that the market created a significant turning point? Well, the area in which we had that was exactly here. So what we have to do is take our box from the low of the wick to the body of the candle. And if we extend it to the right here, what we can see is that this will be our supply zone, that if the market will actually go and test it, we expect the market to show a reaction to this area. And in fact, what we can see is that the market went, tested exactly that zone, and rejected it to the downside, showing the reaction that we wanted to see, because the market has in fact found supply inside of this zone, because every market, as you know, is driven by supply and demand. It's pretty clear how you're supposed to identify these areas on the chart by looking at significant turning points. If the market is approaching it from the downside, that is a strong supply zone. If it is approaching it from the upside, it is a strong demand zone. For example, if we're looking right now at the chart, at the current chart, this would be the most recent significant turning point where the market from here created this move to the upside. We take our box from the bottom of the wick to the body of the candle. This would be the supply zone that if the market will test it, we expect the market to create a reaction to. Now, if we go to the second part, so basically adding order flow, why it is important to add order flow? Now, order flow is basically the commitment of traders. So what the non-commercials, so the biggest speculators in the market, are doing. Why do I like looking at the data of the non-commercials, and why I suggest to look at the data of the non-commercials? Because these are the institutions and big players in the market which are in the market not because they have a commercial activity tied to that specific market, but they're just in the market for speculation, so to actually profit, not because they have some other reasons. For example, I don't know, paying employees overseas or any kind of business-related transaction. They're in the market just for speculation, to actually make money. So these are the guys that you want to be following, because these are the biggest institutions and players in the market. Now, what you want to be looking for when it comes to adding order flow to supply and demand is having the confirmation that in those areas of, for example, supply, you will see that institutions are actually shorting, okay? Because if you have a market, for example, taking the most recent example that we used here, okay? If you have a situation like this, where the market is around this area, you're looking, let's say you're looking for a potential short, so you want to identify the nearest supply zone. You will identify it here, right? Because we have understood already that when it comes to identifying that zone, we have to look left, look at the area at which you have the most significant turn, where we went from bearish to bullish. In this case, it would be exactly from here. We had this massive move to the upside. So we take our box from the low of the wick all the way to the body, and we extend this box to the right. So we know that from here we have demand and support, demand and support, demand and support got broken to the downside. At that point, all this previous demand is turned supply here. So what we can expect is a retest of this supply and rejection to the downside. Now, what we want to see in this specific scenario is that if we are to short from here, we want to see that institutions are at least decreasing their net positions on the euro. Now, if you're looking at the data for the euro, keep in mind that you are already checking euro USD. The reason for that is that all currencies on the spot are traded against the USD. So if you're checking the data for a euro, you're actually already checking euro USD. So what we want to see here is that net positions are getting decreased. Why we want to see that net positions are getting decreased? Because if we get this, it means that from an institutional perspective, we are seeing increase in shorts, which we were getting at the time. In fact, we can see that the shorts went from 179K all the way up to 254K, and we want to see a decrease in the longs, which we can see that wasn't really happening because longs were getting slightly increased. However, they were definitely getting increased at a way slower pace than the shorts, because shorts were getting increased massively, and that is why net positions were getting decreased. So you want to really pay attention to the net positions and realize that, okay, we're actually seeing a shift to the negative side because net positions are decreasing, meaning that the amount of shorts is growing compared to the longs, meaning that from an institutional perspective, from an institutional side of the market, we're seeing a shift to the bearish side. They expect EURUSD to be bearish. Now, if institutions expect EURUSD to be bearish and they're positioning their orders to the bearish side, you have to keep in mind that for them, it's not as easy as for us to just press a button and place the order. They have massive orders. And as you know, in the market, for every buyer, there needs to be a seller. For every seller, there needs to be a buyer. So they can't just place their orders all at once. So they will start selling already from here. They will start placing many orders, sell, 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 sell. But the biggest amount of sell orders that they will have will be usually inside of the supply areas. That is why those are usually the tops, right? Instead of the supply or demand area, depending on what we are looking at. So if you're seeing that already from here, they're starting to short, so you see that their net positions are getting decreased, at that point, you can expect to have even more sell orders inside of the supply zone. And at that point, you can expect a test of the supply and then the rejection to the downside, because at that point, they were already adding shorts here. Here they finished adding all their short positions, and that is where the move to the downside actually starts. And in fact, we can see that in this case, we did have net positions which were getting decreased, meaning that institutions were adding shorts. Here we had the supply zone, so we pretty much expected a test of the zone and rejection to the downside, which is in fact exactly what the market did here. Now, at this point, we have quite clear how to identify the areas of supply and demand, how to add order flow to that analysis. Now we have to speak about how to build a trading strategy around this. Now, this will pretty much depend from your own trading style, trading personality, and how you want to adjust all the rules of your strategy that can be based around these concepts that I have just explained. For example, you can decide that you will only be looking at supply and demand areas on the daily time frame, like we did in this tutorial, or you could be looking at supply and demand areas on the weekly or monthly time frame, or on the 4-hour time frame, or on the 1-hour time frame. That will depend from your trading style, how much you like to be behind the charts. My suggestion is to always focus on multi-time frame analysis. So having the bigger picture, so how I do, for example, in my analysis, in the free analysis that I post here on YouTube, in the forex analysis playlist, where you will see me go from the higher time frames all the way down then to the lower time frames. But when it comes in general to develop a strategy, the very, very, very important thing that you have to keep in mind is that you always have to follow 3 major steps. The first step is that you have to backtest the strategy. So let's say you decide that you want to be looking at supply and demand areas, for example, on the daily time frame, like we did in this tutorial. Then you will go in the past and take a lot of cases, identify a lot of supply and demand areas, look at how the market reacted at those levels. Then, for example, you want to be looking for the direction. So for the supply and demand zone on the daily, then for the entry, you want to go down on the 4-hour time frame. Then you will go down on the 4-hour, see, okay, which are my rules on the 4-hour time frame? From a technical perspective, then you have to speak up, you have to understand and decide which are your rules from a risk management and a risk to reward perspective. So for example, you will be only targeting 1 to 3 or 1 to 4 or 1 to 2 risk to reward, and how much you will be risking per trade. Once you have set all your basically parameters, at that point, you have to start testing that, back testing that on a lot of data. And once you have that and tweaked all the rules, at that point, you can start moving to demo trading, which is the second phase. So back test the strategy, demo trade the strategy to see if it actually performs in live market and if you can actually find consistency with it. And only at that point, you can start thinking about going live. Those are the 3 major steps to develop any kind of strategy. So I really suggest to always follow the steps. And I hope that I was clear in breaking down these 3 steps when it comes to identifying supply and demand zones, adding order flow, and how you could potentially build a strategy around it. If you enjoyed the video, make sure that you smash that like button and comment below. It really does help with the YouTube algorithm, and I will see you in my next video.